Joining me now is Mark Zandi, Chief Economist at Moody's Analytics. Mark, thanks so much for joining. Great to have you.
Thanks for having me. It's good to be with you.
So, Mark, the Fed decided to hold interest rates steady, although two Fed governors didn't agree with that decision. Do you think it was the right move, or do you side with the dissenters?
No, I think it was the right move. I think sitting on their hands makes a lot of sense. I mean, you've got inflation picking up, it's above target. The direction of travel is for higher inflation as the tariff gets passed through to consumers. And I think that'll be the case over the next 6, 9, 12 months. But then you also have an economy that's weakening. Growth is slowing. It's still moving forward, but at a slower pace. So given these cross currents, what should the Fed do? Respond to the higher inflation or respond to the weaker growth? It's hard to know, certainly at this point. So yeah, I think it makes a lot of sense just to sit on their hands and do nothing and see how this plays out going forward.
Do you think the door is open for a September cut, though, Mark?
I do. My sense is that the next move will be a cut. Now, whether that's September or October or December, early next year, that's a reasonable debate. But I do think that the inflation will be more one-off. That these tariff increases, once they get passed through, that the inflation will begin to abate relatively quickly. Although that'll be pretty tough to know when you're in the middle of it. And I do expect some pretty significant increases in inflation over the course of the next 6 or 12 months. But I do think growth will weaken. It's already on the soft side. It's come way down since this time last year, and I think all the trend lines here too suggest weaker economic growth. So ultimately, I think the growth fears will prevail over the inflation fears, and we'll get some rate cuts. But again, whether that's September at the next meeting or October or December next year, that's I think a reasonable debate.
Your view has been that the U.S. economy will avoid a recession, but that it will be close or a close call. What's the variable that could tip us into the recession? And in the next breath, what's really keeping us afloat?
Layoffs. I mean, I think the firewall between the soft economy that appears to be weakening and recession is that businesses at this point have not laid off workers. They've done everything else but that. They've stopped hiring, so hiring rates are very low. They've cut back hours worked. The job growth has come pretty much to a standstill, except for a couple sectors like healthcare and education and parts of government. The last thing they'll do is lay off workers, and I think they're very loath to do that. Most businesses have been through some pretty severe labor shortages since even before the pandemic, and I don't think they want to get wrong-footed, particularly in the context of immigration policy, which has a lot of immigrants leaving the labor force and not working. So I think I think the key here is layoffs. They're low, and as long as that's the case, we'll avoid recession. That's kind of my baseline, but it's a very tenuous kind of situation. And if we see any pullback in consumer spending, I do think those layoffs will begin and we'll be in recession. So it's going to be very, very close. But that's the key variable. It's layoffs.
Are you getting any signals that we could be close to that?
Yeah. I mean, I think everything. It's really, American consumers have really are now very cautious. I mean, if you go back over the period from the end of the pandemic up until the end of last year, consumers were out spending with a fair amount of gusto. Spending growth was strong and very consistent. Since the beginning of the year, consumer spending has gone flat. Now, flat consumer spending, I think, isn't enough to push businesses to start laying off workers. But if the tariff price increases start to kick in, undermine real incomes and purchasing power, and consumers actually do start to pull back on their spending, even a little bit, that's when businesses may decide, hey, look, we're going to have to reduce payrolls, we're going to have to lay off some workers. And the thing about layoffs that's a bit disconcerting is, once one company in an industry lays off, you tend to see all the other companies in that industry lay off as well. And you can go from no layoffs to a lot of layoffs pretty quickly. And, I think we're right on the edge here. Hopefully American consumers hang tough, continue to do their thing, don't pull back, and, we'll avoid that downturn. But If they do pull back even a little bit and businesses respond by laying off, you get into that kind of self-reinforcing vicious cycle called a recession.
Well, we also have the tariff deadline on Friday. We know that President Trump has said it will not be extended. We'll see if that's actually the case. But it sounds to me like you think that will be more of a one-off kind of price shock. But how should we be thinking about the economic impact of even one-off higher prices?
Yeah, it's not good. I mean, and in fact, you look through all the ups and downs and all the rounds in the tariffs and the noise. Tariff rates are going up, and they're going up a lot. I mean, if you go back to the beginning of the year, the effective tariff rate across all countries' products was just over 2%. Now, with everything in place, it feels like we're going to settle in somewhere around 15 to 20%. That's a very substantive increase, and that means higher prices and inflation will pick up. I think the price level will rise by a point and a half. So instead of inflation, where it is today at 2.5%, that's the consumer expenditure deflator. That's that measure. We'll be at 3.5, 4% by next spring, summer. That's pretty substantive. And it'll also mean weaker growth because that those tariff increases, those higher prices are effective tax increase. It cuts into people's purchasing power. If I have to spend more on an imported good, food or clothing or whatever it is, I have less to spend on everything else, and so that cuts into economic growth. So I'd buckle in. I think the next 6, 12 months are going to be uncomfortable for the economy. I think we'll be able to avoid recession, but it's very close, and I think we can state with a high degree of confidence that it's going to be an uncomfortable environment.
Well, we have seen the stock market turn modestly lower as Fed Chair Powell speaks, but stocks are back really near all-time highs. Would you say the market is overestimating the resilience of the consumer and the economy then?
Yeah, I think so. I mean, part of that is just AI, right, and driving a lot of activity among a very small group of companies that have done very, very well. And that's running on its own dynamic. It has nothing to do with the business cycle. That is, just completely independent, and that helps to lift the entire market. I think if you exclude that group, then the rest of the market is more representative of kind of the thinking around what's going on with earnings and companies and interest rates and that kind of thing. There's more the increases in stock prices are more pedestrian, but even that, I suspect, markets are now, investors are now at a place where they're listening to people like me and they say, okay, I hear you, but I got to see it, show me, and so they're waiting to see it in the data before they respond. But I think they'll see it in the data. I'm confident that they will, and so it wouldn't be surprising to me if we saw some sell off in parts of the market. But again, that the folks, the companies that are in the world of artificial intelligence and everything that drives that and benefits from that, that's running independently of everything else.
All right, Mark, just finally and just quickly, bringing it back to the Fed. Obviously, the Fed holding rates steady wasn't a big surprise here. Did you learn anything new from Fed Chair Powell today? Were there any surprises to you about what the Fed had to say?
No, it's kind of right down the strike zone, I thought. I mean, it was, obviously when you see two Fed members on the Board of Governors actually dissenting, that's very unusual. I think you got to go back into the early 90s to find that happening, the last time that happened. So, there is a growing fracture in thinking on the board. But it's not a surprise, but it is, noteworthy once you see it happening. It's very unusual to see this kind of dissent, and that dissent is, in full swing right now. But, having said that, if you believe that we would get rate cuts down the road, it wouldn't be surprising that you start to see some dissent among board members. Some people are going to feel like it's important to cut earlier rather than later, and that's what we're seeing. But that, to me, that was the one thing that stood out from this meeting.
Okay, we'll leave it there. Mark Zandi, Chief Economist, Moody's Analytics. Thank you so much. Really appreciate your insights.
Yeah, anytime.